Just wanted to get into one final concept with you guys before I go. You know, basically, the whole market, right? And this more applies to the stock market, but I believe will eventually apply to some of the crypto trading that you heard me talk about earlier. Uh, Let me talk about why market timing is not a good approach. Because you hear that so often in this, and it's just the nature of this business where people will think that if they get out at a certain time, they will be able to come back in when it's higher, or if they get out at a certain time, if President Trump wins and I can get out at this time and enter that time, and then if and people try timing the market based on certain events that'll occur throughout the year, and they'll do sell-offs, right? And let me tell you why that's just it's been proven that it's just not the good approach. So there's two types of investors. There's technical investors and there's fundamental. That's kind of how we have divided them up amongst the investing community. And the technical investor will tell you they're more of a psychological approach. They more look at momentum swings. They'll tell you that I bought Apple today because I believe in 2 weeks that people will view it in a different way because maybe the iPhone will have this touch and that touch, and I'll buy this company because that product's coming out and I think people will view it better. So they try judging things and try determining things based on swings and momentum. They'll look at something called an SMA, simple moving average. They'll look at when the price crosses a 50 simple moving average, which means that it's trading in a momentum that's kind of favorable to a favorable trend. So that's what a technical investor does. A fundamental guy is more, think of the Warren Buffetts of the world. They try finding things at a discount. They look at intrinsic value. They look at your balance sheets. They look at metrics. They're the ones that will look at PE ratios, EPS. They'll look at net income growth. They'll look at really what drives the company's financials. And to be honest, I think both approaches are necessary in doing analysis. I'm about 80 fundamental and about 20 technical, maybe even 90-10. So I just want to talk a little bit about the concept of market timing and why it can be really dangerous. So just bear with me for a second. Every bear market that has ever come, in our history of the United States has averaged about a year. And they do usually cost us about 30%, which is a lot. But if you don't sell and you remain patient, they will not cost you anything. You heard me right. They will not cost you anything. In 2 centuries in American history, every single bear market was followed by a bull. Schwab and JP Morgan did a study over 20 years. The S&P 500 goes up 8% every year. So that means you double your money every 9 years. But in those 20 years, if you were out of the market on the 10 best trading days, your value went from 8% to 4%. Think about that. 20 years, if you were out on 10 days, your value got cut in half. If you missed the 20 best trading days, you only made 2%. If you miss 30 fucking days in 20 years, in 20 years is 7,300 days. If you miss 30 days in 20 years, you end up in the red. You actually lost money. The most dangerous thing you can do is to not be in the market. Even if you bought on the worst day of the year, right? You hear people say, we're in a bubble, don't buy. Even if you bought and when the market's at its highest, because right now Apple's trading at an all-time high, Microsoft's trading at an all-time high, Google, Facebook, Amazon, these companies are at their all-time highs. Even Bitcoin, Ethereum. So even if you buy on the worst day of the year, and this applies to the stock market again, when the market was at its highest, you beat holding onto cash over a 10-year period every fucking time. And that's because of compounded interest. And anyone that understands compounded interest would understand that concept. Because if you invest $1 today, when you get interest on that dollar, you don't keep applying it based on that dollar, right? If you get $1 and there's a 10% interest rate and it turns into $1.1, the next year it compounds based off 1.1. It doesn't go back to 1. So if you understand that concept, you would easily understand why the best thing you can do is to be in the market, to diversify your portfolio. I'm not saying go in there and buy shitty stocks. Diversify your portfolio and add tech, add finance, add, different types of sectors. And, once you make those diversifications, I think you will be in a position to grow your wealth. And now, one of the best things you could do by diversifying your portfolio is adding cryptocurrency. So that's why I'm trilling on it. Crypto George out. Peace.